What we have here for the world to look at is to look at some very hardcore factual evidence. The MMTs are here gathered on Saturday at 7:45 a.m. 10/22 at 2011, and happy Halloween. What we would like to talk about is, in our previous analysis, is how we would hit the lows on the S&P, and because that the technical part of a short cover rally for 3 weeks off of the low is that we've taken out some major resistance levels across these tops here on the S&P, and we have. And that the previous week was a buy above this line at the 100-week moving average. This blue line is a 10-week moving average. So when the tops over here that we had clearly called for a big correction back in May, and the way that many educational groups are looking at this video, what you would want to do is go to stockmarketfunding.com and type in S&P 500 indexes. So if you want to share them with your groups of people or your educational groups about the market, that you will clearly see how accurate that this was and the analysis was. The 52-week lows that were being put in calendar 2012 and the actual volatility, both between a bear and a bull volatility, you got bear volatility and bull volatility, is that when the weekly moving averages were going down and we undercut that, the SMF index qualifier and equity qualifier for bear and bull trends to be established mathematically are always correct, and one of them is that the 10-week has to be declining, as we were, and that you have to close 4 consecutive calendar weeks below it, and that the 10-week would have to rapidly fall below the 20-week moving average, which is the red line. This long-term 100-week moving average is where we kind of have flattened out, and that was a major resistance level. And in the last 2 calendar weeks from the 1075 low, we have clearly taken that out. What the market will have to deal with, because they're in the earnings season right now, and some of the earnings are okay. They're not great, but then not a lot of them are horrible. But then again, as the SMF CEO publicly traded company index says, that they would not have anything great to say forward looking, and they would not want to be a hero with a lot of upside guidances, but they would rather be what? More proactive in being conservative forward looking as we close out calendar 211. One of the most important things that the public lacks is the proper education of understanding the mechanical part of a market and the control mechanisms. So if I've got all the world bailing out and I've got all the world with a big short interest on the indexes, when the indexes hit a certain amount of short interest, because when we were up here in the calendar year, we had very little short interest. When we were up here, there wasn't none. So as our analysis would be very clearly defined, is because when there isn't no short interest, that's why stocks and indexes and stocks in the S&P would blow through their support levels and continue the selling, because there was no reason to buy to cover, which would ultimately give that support level, because it wasn't there. Now, short interest on indexes and equities across the board is when you hit a certain mathematical number, there will be buy to cover, which pulls these things up off the bottom, and as the short interest comes off, you get these great bear rallies. Okay? A lot of people, including a lot of the professional community, needs to understand, and the public especially needs to understand, not to be sucked in. And what will end up happening as the short interest buy to cover propels and moves them up to their resistance levels like they did here before they've finally made their miserable lows over here. And as we had said back in our analysis a year ago at this time, by the way, is that if anybody was holding these markets up here before this big collapse happened was, hey, cash it in, get out of the way, because you're not qualified. And the volatility and all of these mechanical gimmicks and all of these various little tactics that happen on Wall Street and what the exchange model is, the public is always the one who suffers and gets taken to the woodshed. It was very important to us here at stockmarketfunding.com that the innocent people, our biggest concern for the public, and the public is the one that really doesn't have the wisdom of how these markets work. And it was very important that we care about people, and we have said that in many of our analyses that we do care about you, because we don't want you up here and we don't want you have to go through this kind of problem. Now, there's a time to buy, but now that the short interest is coming off, the bull mentality has really stayed on the sideline. There's been some buying now. However, most of it is mechanically buy to cover using the futures market that take these things back up. Traditionally, calendar in year in the fourth quarter is where rallies happen in November and travel through December. However, the move has already started here. And our big concern for the general public now is that the rally has already gotten from here to here. And what will end up happening is that fund managers have miserably been underperforming calendar 2011. The things that we're going to be looking for as we close out October and we get into one of the most bullish parts of the market is November and December. But let me tell you something. The low on the S&P, which we called for, was 1075. I'm sorry, we were a couple pennies off. 1074 to this current closing price on a weekly level high of 1239.03. Now, having said all of that, let's do our math. One of the things that we would encourage the public to listen to us for is please don't feel that you have missed the boat, and please don't feel that you have to just get in at the highs, because our concern is for you. And MMTs, on the other hand, that are in our 52-week apprenticeship, they don't have to worry about these things, but we know that you do, and we're working for you because we care about you. And we want you to know it, and we don't want you buying up at the high when we're going to be going into resistance. Now, the bull will get to a point where the train leaves the station. I will tell you from the low of the S&P to the top of this weekly is that 164 S&P points from here to this current resistance level, which is a 20-week moving average, and it is bullish because it's a weekly moving average, and that's the way it looks. But remember that both the blue line, the 10-week, and the 20-week are starting to flatten out, but they're still crossed over that 50-week. Now, in the world of standard deviation of technical analysis, that's how the broader public was fed to make decisions. Whether you're the small mom and pop or a big multi-billion-dollar fund manager, investors, they all make decisions the same way. Okay? And what happens is the buying opportunity was here. Now that we are getting up here, we're going to come up, and the 1250 handle right here is going to be the major area. This is the artery, and it's a wedge pattern that's gone straight up in 3 weeks. But then again, you went straight down here in 3 weeks. So let's look at the math. Straight down, we cleared through this level right here. We took out these reversal tops within the overall structure of the S&P 2011 52-week low process called a bear. And we've gone through the bear, and now the bull is trying to come back. And as the weekly moving averages flatten out and turn up, that's bullish. As you're above the 100-week, that is too bullish. And the long-term green line is a 200 week, but it keeps declining as you're going up. That is extremely bearish. So what I will tell people is that this 50-week moving average, which is this line here, is going to be the wall of resistance. Just as you had broke through that 50-week moving average from this current level over here, you can clearly see what can happen when you break a key moving average. You went straight down from that level when you broke through it. And stock market orders got triggered, and people were selling and selling, and margin debt was happening, and everything that was happening, and people were panicking out, and they were getting out of the way. Okay? Now, look, the problem that the bull will have going into the calendar year is that this is going to be the major wall of next resistance up here. And that happens to be at 1266.76 on the 50-week moving average. And that there is a bull case here, but then there's also a bear case. There's two cases. One's a bull case and one's a bear case. The bear case is the wall of resistance. And the bear case is that once you get up here and you cover that short interest, this is where, until you can close above it, you're not going to get back up to this next neckline where the 2012 or 2011 going into 2012, when we go into 2012, if we were to clear that 50-week moving average, there's still going to be the wall of resistance. Economically, nothing has changed. Nothing has changed. Mechanically, and the gimmicks that go on in the exchange model are to walk the bear to the top, and once the bear is walked out of the market, back up here, then the bull will end up having to deal with, what do I want to do? Am I going to get off the train, or am I going to stay on the train? What we are saying is that the key catalyst at 1248, which is about 12 handles above the market, but 1266 is going to be that wall of resistance on the S&P. And that we're going into a major forward-looking this next week to close it out, is that the earnings in the S&P 500 of about 100 companies that reported last week, they're not all that bad, but they're not all that great. They never are, because they haven't written down the S&P 500 valuation. The problem is that the big money from a textbook level, and textbook level is one thing, but the hardcore reality of the intrinsic value of how markets move in bear and bull, that's the education that you want. Everybody can say, hey, forward looking 12 times earnings, 11 times earning on the S&P. I haven't seen that since 1957 and all of that. Yeah, those are great bull cases and normally would be the greatest buying opportunity. But look, when you have growth contracting and you've got worldwide systemic events around the world that are going to happen, you can't say that even 12 times forward looking earnings would be that cheap, because the system is overburdened with debt. Worldwide derivative debt is at levels that if you compounded the whole world of what it was worth, you've got more debt than what the world is worth. And that's been a hidden event for many years and always has been. And that accumulative debt has happened over the last 50-year period. And we want people to know that in this time, that Ben Bernanke, who did QE2 last year, created the high commodity level prices and choked off growth. Otherwise, our forecast would have never been true. And our forecast was true. So the educational groups and or bigger firms that may be watching the video, what you want to do is go back to the mid-year point and look at all of the analysis that SMF has done. Remember, whether you're a big fund manager, hedge fund manager, or regular public people, we're here working for you. And the reason why we put this out live ahead of the event is because we care about you. And we can't even say that enough. We just don't want you to become a victim to Wall Street. Because our major concern is there's a time to be a buyer. There's a time that markets have changed significantly in this decade. And people treat the market more of a big casino, just like going to Steve Wynn's hotels. and playing baccarat or blackjack or whatever the case is that the markets these days for people they treat it that way. This is not a casino. This is serious stuff. And the thing about it is, everybody, including 8,600 economists, were all bullish for the calendar of 2011, but they all got washed out. And most of the people were all out down here at the bottom. They did their selling, they got their margin debt selling, they got their markers called in, and once that process happens, that's the time that you start to go higher. So basically what we're saying is that the 50-week moving average is the wall of resistance. What we're also saying is Twister, QE3, what Bernanke has done, is going to be an overflow, and these things usually take about 180 days, 4 to 6 months before we start seeing higher fuel costs again, we start seeing high food inflation again, and we start to see things running rapid around the world. As Europe starts to print more money like the US did, is that eventually the more that you print and you're not solving the debt issue, there is a consequence to it. And you will need to stay tuned that going into 2012, we're here working for you. We're always working for you. And the reason why we're working for you is because we know how devastating that the consequences from here to here can be. And the majority of the crowd, even the bull crowd, they don't get on board until you get up here. They miss the majority of the rallies as well. And that markets, if they're done and used correctly, and if risk management and analysis is applied the right way, you can fare the storm. However, there's one thing you will never fare and never come out on top, is when you treat things in a casino type fashion within the market structure, you will lose. So I'm putting a major resistance level at the 50-week. There is a bull case here, there's a bear case here. So between the bear and bull structure going into calendar year is that it's not abnormal. That's why we were buyers down here. It's not abnormal to come all the way up here, hit that, and or come up here to the 1300 neckline before you roll over. The thing about the rally is the majority, a lot of the rallies already happened for year end that we normally see in November and December. It already started here in October. Okay? And a lot of it was short cover interest. We're going to be doing other things that are very important for you. So what I want people to do is really be aware of what these major resistance levels are going to be and what markets do and how you can avoid that, but how you can take advantage of this. So moving forward, stay tuned.